Welcome back everyone to the Money Control live stream. You're watching Markets with Santo and CJ. And well, what a smart recovery, Santo, for the benchmark indices after a very weak start in the beginning. If you look at the Nifty and Sensex, they've fully recovered from the day's low and are now sitting quite firmly in the green territory, but led by a lot of the index majors, RIL, the HDFC Twins, and in fact Infosys as well, joining the comeback in the benchmark indices. But it's the broader market that will be a little bit of a concern, Santo, because if you look at the Nifty mid cap, Nifty small cap, they have been lagging behind, especially the small cap index, which is still in the red territory. And overall, it seems like a bit of a a two-way market at this point of time, at least for today's session.
Well, the run-up in small and mid-cap stocks have been much steeper compared to the large cap, so not really surprising that we're seeing some kind of consolidation happening out there.
Yeah.
Which is not a bad thing after such a steep one-way rally in these stocks. But I think, CJ, most importantly, the buy on dip strategy so epitomized by the millennials and the Robin Hood generation seems to be working quite well, like a charm once again.
Well, never missing a chance to take a dip.
No, I didn't
Santo,
taken a dig at you in a long time, so I thought it was.
I don't think, Santo, the dip has been that bad so far. I mean, even if you were a buyer at 17,000, you're still sitting on at least 600 points of profit. So I don't think overall, if you look at it from the June lows for the past 3 months, I think you were still sitting on a good amount of profit. Yes, your profits have trimmed a little bit if you have held on to a position. But overall, in general, if you look at the narrative that is emerging, Santo, from a lot of the investor confidence that is conferences happening across the country, especially in Mumbai and Delhi, most of the corporate India still seems to be quite buoyant about the domestic
I think we are hearing different phrases there. Yeah. Now some say it's a cleaner shirt in the dirty laundry, yes. And the other day Rhythm Desai on the CNBC TV 18 channel was making a comment about India being the
large cap within
the best house in a weak neighborhood, the strongest house in a weak neighborhood.
Exactly.
But that said, CJ, I think we should brace for some bit of volatility, given that the interest rate hike is still not behind us. We are going to see the Fed hike rates and the ECB, Bank of England, and given the situation, the inflationary situation in both Europe and England in particular, some more rate hikes clearly seem to be on the cards out there.
Santo, and if you look at the volatility index, the India VIX, now it has, it was sitting somewhere around the 17 odd level for the past month or so, but now it has inched up towards the 20 mark level, which clearly shows that market is bracing itself for more uncertainty and volatility, because you have a major event later this week happening. So that, of course, is a key trigger for that. But apart from that, individually, Santo, a lot of stocks were buzzing in trade, especially with the cement sector being in focus in particular.
Well, the Ambuja Cement was clearly the star performer of the day. Spectacular run up there over the last 1 month. Now it's going through the major re-rating process at the moment if people in the market are to be believed, CJ. And the obvious trigger, the immediate trigger is clearly the Adani Group taking over the company. Now, the theory is that there will be a lot of efficiencies and cost savings with now that Ambuja Cement is part of the Adani Group, both in terms of fuel energy costs as well as logistic costs. Everything is going to come down, and that will obviously result in a fairly good kicker to the margins. But that said, a section of analysts on Dalal Street are a little concerned now. The Adani Group has got big plans, ambitious plans for both ACC as well as Ambuja Cement, and what Kotak has pointed out in its note is that the kind of money that Adani Group is pumping in to expand capacity, clearly that will have other rival companies also doing the same. That's because at this point in time, the overall leverage in the sector, in the cement sector, is pretty low, which means that there will be a race to increase capacity. Clearly, the Adani Group has made its intentions very clear, and it's very unlikely that some of the other big players, notably Ultratech Cement, will be sitting. In fact, Ultratech already had said that it's planning to increase its capacity. So, higher capacity is something that you can't ignore at some point in time, unless the demand keeps growing at that consistent pace, which at this point in time, again, not many people are hopeful about. Kotak has downgraded the stock to a sell. Citi and Goldman Sachs are the other brokerages which are negative on Ambuja Cements at this point in time.
Well, Santo, I think if you look at the the supply argument, there are two ways to look at it. There is one way, in the one route which Ultratech went with, and that really spooked everybody in the market, is when Ultratech was going for a greenfield capex, which is basically adding a new capacity altogether into the already existing capacity available in the market. Now that generally will tend to raise concerns that if demand is not growing at that pace and if supply is growing at a higher pace, then of course you have a situation of oversupply in the market. What I think is the case in the case of Ambuja Cements in particular, Ambuja ACC together, is that there's a possibility that there's more consolidation happening. I mean, there is a possibility of more M&A, maybe more brownfield capex happening, which does not expand the overall pie of the cement sector, but generally consolidates or concentrates more and more capacity under probably the top 3 or 2 players out there in the market. And I think that is where a lot of the confidence in the market is coming from with respect to Ambuja and ACC. Despite that, of course, you mentioned that the cost benefit, I think, is one of the most obvious triggers for re-rating as far as Ambuja and ACC are concerned. It's largely down to the fact that the interlinkages between Adani Ports and the clinker facilities or else the cement manufacturing facilities themselves are going to bring down cost savings so much or create so many cost savings that competitors or rivals will not be able to match, and they will have to find different ways or probably become candidates for takeover from a company from a group like Adani. So I think that is where the market is sensing that there is a lot of market share to be gained for Ambuja and ACC going ahead, which they were not doing for a long time because of a very conservative promoter earlier. I think therefore this re-rating doesn't seem out of order at this point of time from my perspective. And if you look at what Jefferies had to say, they have raised their EBITDA estimate alone for FY24 alone by almost 20% and almost 25% for FY25. So they clearly are seeing a huge jump in profitability going ahead, and hence the re-rating and hence the upgrade as well to buy. Well, the first stock on my radar today was Schaeffler India. Well, stock took a pounding today after brokerage firm Kotak Equities downgraded a stock to sell rating. They believe that although there is no concerns with respect to the medium-term growth prospects of the company, market, it seems, has already priced all of it in, and therefore upside from here on will be very, very limited. So if you're incrementally buying Schaeffler at this point of time, maybe you will end up not making much money from here, and your downside risk therefore becomes much higher. So in that sense, that is the reason why they have downgraded a stock. And another factor which they feel is also responsible for this downgrade, Santo, is that when they did their own analysis, they felt that the market was pricing in almost 19% growth in revenues of the domestic business. Now, when you look at the automobile space, they are not expecting more than 7 to 8% CAGR volume. So in that sense, where does the next remaining 11 to 12% come from? So probably the market has just jumped ahead in its optimism for the stock. And I think therefore Kotak has downgraded a stock, and they believe that at this point of time, probably given the long-term growth prospects, given the medium-term growth prospects are still quite good, if there is a decent correction in the stock, then it could make for a good entry point.
Well, CJ, I think if you make a case for overvaluation, right, then probably Schaeffler would not be the only candidate out here. There are plenty of stocks out there, and in fact, it's one of the truisms in the market that stocks don't rally just because they're cheap and they don't fall because they're expensive. I was just going through the numbers of Schaeffler, and what struck me is that the growth over the last many years has been pretty consistent, and most importantly, even in this kind of a tough market, they have been able to maintain their operating margins around 18%, and that takes some bit of doing. And most importantly, over the last 5 years, even including that you had a COVID year where revenues would have taken a big hit, compounded growth in top line is 25%. Now that's quite a bit. Now if Kotak is bearish on Schaeffler indirectly, that would be indirect warning for many other auto ancillary companies also.
Absolutely, I think because
which
we
means that
have seen a very smart rally within the entire space.
The whole auto revival story itself is under some kind of a cloud, I would say.
Yeah, so I mean, everybody is keeping their fingers crossed with the festive period. I think the Q2, Q3 numbers, as and when they come out, the September and October, sales data as and when they come out will probably decide the fate of this auto rally. Because if there is disappointment there, then there is expected to be quite a sharp correction going ahead.
In fact, the numbers have been improving quite sharply over the last 3 or 4 years.
I think the export business is something
it's almost
that's been leading the revenue revival, I think.
Almost doubled. The revenues have almost doubled in the last 5 years, and which is quite an impressive performance. Well, next stock is Escorts Kubota. Very surprising, CJ. This is one stock which all analysts panned after the first quarter numbers.
And the stock is up upper circuit today, I think.
Yes, around it's over 2,000 rupees. Now it's hit a record high once again today. Now the reasons for analysts turning bearish on Escorts Kubota was fairly justified. Margins took a beating, the company lost market share. Now, at this point in time, there is still no clarity whether it will be able to come up with a better than expected second quarter performance. Many analysts have been quite skeptical of that, although the management has been saying that September and October are traditionally very good months for the tractor business in general because of the festive season. A lot of buying of tractors happens around this time. Now, the company has 3 lines of businesses, the other 2 being construction equipment and railways also, but the bread and butter clearly is the tractor business, and unless you see some kind of a very strong revival there, I think there could be it could be difficult for the stock to sustain this gain. Now, again, the news of the company having amalgamated 2 of the privately held arms, which is Escorts Kubota India and Kubota Agriculture Machinery. In these 2 companies, Escorts and Kubota hold stake, but in reverse, 60-40 in the first case, Escorts Kubota India, and 40-60 in the second one. Now, there is some bit of equity dilution there also, however small, and this was one of the preconditions at the time of the merger. But that said, I think still the main focus is going to be the recovery in market margins, where probably to regain market share, analysts fear that Escorts Kubota will have to further take a hit on operating margin. There is some cushion there, although the input costs have kind of they have come off quite a bit of late. But that said, still it is not an easy task for Escorts to regain its market share.
Well, Santo, clearly arguments are quite fair, but I think what market is betting at is that a quite significant revival in demand as far as tractor sales are concerned over the next coming few months, also on the back of what has been a very normal monsoon. So it will be very interesting to see whether tractor sales do come back in a big way, not only for Escorts but the entire industry as well, because there were some concerns after July numbers came out that the tractor space was probably showing some signs of stress, but it will be interesting to see if that turns out to be a false dawn. Apart from that, of course, what the company needs to address is the loss in market share over the past 1 year. If you remember, during post-COVID lockdown, first lockdown until the next 1 year, Escorts were actually gaining market share. But then suddenly out of the blue, it started losing market share quite significantly as M&M picked up its game. So going ahead, if the company can convince the market that it is on its way to regain some of that market share, I think that will be clearly a big kicker for the re-rating that is presently undergoing in the stock. And if you look at it from a technical point of view, Santo, I take your point that the stock is sitting near record highs almost at this point of time. But if you look at it, a daily momentum indicator like an RSI, that is still not at overbought levels at this point in time, which goes to show that probably there is still quite a significant room for the stock to run up, and maybe we are seeing maybe a new rally in the stock after what has been a very, very muted 1.5 years for the script in that sense.
Fairly possible.
Well, the next stock and last stock on my radar today is from the jewelry space, and this is Kalyan Jewelers. Well, it seems like the stock is sort of gaining some favor with the market recently. If you look at the recent performance, it's been quite steady, and overall, brokerage from DAM Equities came out with an initiation report on the stock. They have given a buy rating, expecting quite a strong compounding as in terms of earnings. Their argument is that the company is likely to expand its store network at a healthy rate of about 11% per annum, which will help it gain a lot of market share from the unorganized space. It does not need to compete with Titan to gain market share. There is enough shift from unorganized to organized retail that is happening, also in lieu of the recent hallmarking norms that have come in from June this year. So clearly there is a lot of market share to be had, and I think DAM Equities is backing Kalyan Jewelers to gain a significant percentage of that. They're expecting almost 61% annualized growth in net profit for the company over the next 2 to 3 years, which is humongous, and you don't want to miss out on an opportunity or an earnings revision like that. Overall, they're expecting about 30% returns from the stock over the next 12 months. Of course, this is just 12 months. I mean, if you look at it from a 3 to 4 year point of view, maybe you could see even more returns going ahead. But at this point of time, this is one stock that looks likely to be in the limelight, especially given that we are entering the festive season and the wedding season in the coming months.
Well, HNI certainly seem to have taken a shine to this stock, if I can use that phrase, over the last week or so. Huge volumes in the stock. Institutions still are staying away. The institutional holdings is pretty less, and one of the reason I think could be that in the last 4 years, we have not seen any meaningful increase in the top line. Although the bottom line has almost grown nearly twice, but if you look at the top line, the numbers are just about meddling.
I think Santo, a lot of it would be down to also the impact of COVID. The way we have seen with Titan also, Titan has only, I think, in the March quarter come back to pre-COVID levels. So maybe Kalyan Jewelers also can defend that by saying that they also were impacted by COVID, and therefore they've just taken it a little longer to come back to pre-COVID levels.
Well, last stock on our watch list for this afternoon is Bank of Baroda. Again, stock is riding the bullish wave for banking stocks in general. Now, again, a word of caution here. If you have been holding on to Bank of Baroda shares for more than 10 years, then probably would be just waiting for the price to break even.
But like the case was with Wipro and NTPC.
Most of the stocks, you look at the rally in the last 3 or 4, let's say last couple of years, and suddenly you regret not buying the stock.
Yeah.
But if you were to step back a little bit and look at the price chart of the last 10 or 15 years, you get a completely different picture. Bank of
Clearly,
Baroda.
this is no HDFC Bank. I mean, come on.
Yeah, but this has been a re-rating candidate for quite some time now. Now, the big question is will the company's fortunes really turn around from these levels? It's been in the works for quite some time, never happened in the past. Now, the first quarter numbers were quite robust, and that's what really got market excited. A lot of brokerages have turned positive on Bank of Baroda. Motilal Oswal, Morgan Stanley, Nomura are the ones which are quite bullish on Bank of Baroda. Nomura has a price target of 140. Motilal Oswal has a price target of 150 on the stock. It has upgraded its earnings estimate for FY23 by about 22%, and for the next year by 11%, and this is on the back of higher net interest income and also lower credit costs. The CASA ratio for during the first quarter was about 44.2%. The management said that growth in its corporate book has also been pretty robust at 17%. Overall, it's aiming for a 15% growth in its loan book for this fiscal. So things looking good at this point in time, which could partly justify why the stock has been really moving up very sharply over the last few
Clearly,
weeks.
Santo, I think this is probably one of the proxy plays to the capex revival story. Much like SBI, of course, it's the big brother in the PSU space. Clearly, Bank of Baroda is now becoming that second stock that a lot of people are moving on to, because probably the upside on SBI at this point of time seems a little limited given the fact that the stock is already near or at its record high. So Bank of Baroda is clearly benefiting from that. And now with the signs of clear credit offtake, a very, very much cleaner balance sheet from maybe 6 years ago, there is a lot of cause for optimism as far as Bank of Baroda is concerned. And in a stock with such a strong trend, uptrend, it would not be wise to bet against it unless you really see some signs as far as the fundamentals are concerned.
Well, and let's have a quick look at the market at this point in time. Nifty and Sensex both holding on to gains at this point in time. Nifty is up by close to about 92 points and holding pretty firm above the 17,600
Yes, and
mark.
Santo, I think even in the mid-cap space, we have seen a little bit of recovery. The Nifty Mid-Cap 100 Index has just about, turned into the green territory, almost on the flat line at this point of time. So clearly struggling from some bullish momentum. But the small cap space is where the story is today. The Nifty Small Cap Index down about 1%. If you look at the some of the sectoral indices that are doing quite well today, is the Nifty FMCG space. Very surprisingly, despite the very contrarian report that came out from FMCG, from ICICI Securities with respect to markets optimism for margin revival, Nifty Bank, Nifty Auto, and the Nifty PSU Bank index, as Santo suggested, up by almost 2.2% at this point of time. So clearly a very, very good day overall for the market, and especially for the large cap or the frontline stocks, Santo.
And so what do we have to keep an eye out for, CJ?
Well, Santo, there's not much in terms of data points today, but tomorrow market will be looking out for the housing starts as well as building permits data in the US, and that will be something that will be a string of data points that the market is looking at ahead of that crucial Fed decision day on Wednesday. So it will be something that to keep an eye out on. But apart from that, it's a very data light and event light day today. Some of the European markets also include, especially the UK markets, is actually closed today with respect to the funeral of the Queen Elizabeth II's funeral today. So therefore UK market will be closed. But apart from that, not much on the economic front.
Well, with that, it's a wrap on this edition of Market with Santo and CJ. Thanks as always for watching, and please do post your feedback in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live tomorrow morning at 9 a.m. Till then, have a good day.